Welcome to Trading Justice 586. This is Mark Justice, joined with my brother Matt, and we are going to break down some increasing bearish arguments. I always have a fun time, and I think my brother does too, analyzing arguments, right? Mm-hmm. And bears have started to come out of the woodwork a little bit more lately. And so we have compiled, looking at numerous bearish authors and strategists, 5 of the most common arguments out there right now. We're going to break those down. We're going to give you a little earnings preview, break down market activity from the last week. But before we dive into any of that, Matt, I just want to mention that we have a very special event coming up. We're always looking ways to give back to our community who gives so much to us. And we are going to hold a special Master Trader event that is going to be free for everyone. Pro member, non-pro member, YouTube, Trading Justice listener, our whole community. We're going to hold a special Master Trader event July 15th and July 16th. That is a Monday and a Tuesday. And we're going to break down some of the core elements on how to become a Master Trader. Matt, this was your idea. Talk a little bit about the upcoming event. And well, hey, what's up while we're at it?
Good to be here. Thank you for that. I'm excited to teach the upcoming Master Trader class on technical analysis and basic options. And typically we do this course only for pro members, but in July, for one time during our holiday sales to celebrate the birth of our nation. Happy 4th to everybody, by the way. We wanted to do a free educational event. It's our Master Trader course, and all you have to do to sign up for it is actually hit the registration button and just sign up. No cost. It's free for our entire community. So come if you have any interest in learning how to trade. This is the class for you. You're going to learn a tremendous amount. And we're going to have a tremendous amount of fun as well. The link is in the description of the podcast. You can go ahead and click that wherever you're listening to the podcast. So definitely sign up for the upcoming Master Trader. And while you're at it, you can also head over to tackletrading.com and hit the storefront, and you always can become a pro member of Tackle Trading. This is a great time to become a pro member. You can sign up for an annual membership and get a substantial discount against that pro monthly. And so if you want to become a pro member, this is a great time to do it during the July 4th holiday season as well. And that also ends on July 15th as well.
Yeah, no, listen, we got a great community. One of my favorite lines to describe some of the coaches, Matt, is you can measure our experience in decades, not years. And, that experience comes through. I mean, we have been through just about every market scenario you can be.
We've seen them all.
We've seen them all. And so when we hear bear arguments like the ones we'll outline in a few minutes, we can provide some content. It's not like it's the first time we've heard bears make a case. And sometimes they make a very good case, sometimes not as much. We'll give our 2 cents on the current bearish
of the podcast. They'll recall the 22 market arguments. There were bear market arguments every single day, every single week. Not as much in 23, but they are certainly starting to come back.
They're picking up
recently. And, it's not that I believe in all of the bear arguments out there, but I think it's important to go through them to have an understanding of those arguments, because, again, you can see some viability in some, you can see some nonsense in others, but it helps you solidify your own opinion of the marketplace. And, this philosophy, Chucky, in analyzing the opposing case, this goes back to when I was in law school, and you would have to, not focus on your argument, but I had a lot of law school professors that would tell me it's more important to understand the opposing argument so that you can better understand your own itself.
And Matt, I want to stay on that for a second, because seriously, as a trader, as an investor, as someone who manages your own money, you need to understand the side that you're not on. Now, sometimes you'll be bearish, sometimes you'll be neutral, sometimes you'll be bearish. You're a trader. You have great flexibility to do whatever you want, right? But what's the case, right? Does it have merit? Because if you just dismiss it, that's where you get in trouble. that's where you can get in trouble.
You know,
So, but
I speak as a bull. I talk about that quite often. I would describe myself as a little bit of a perma bull in the sense that I believe in the U.S. economy long term. I believe in the U.S. marketplace long term. I believe in the U.S. companies long term, but that's long term. In short-term analysis, there's always moments in time where you deal with corrections in the market, or even bear markets with 20% downward movement in price. And so it's important to understand those arguments, because if they do manifest themselves, we want to make sure that we're positioning to take advantage of that. Or even if
otherwise you're just a buy and hold investor, aren't you, Matt?
And there's just not, and it's full of nonsense out there, which a lot of times bear arguments are full of nonsense, quite frankly. But you want to have a deep understanding of it, even if you don't necessarily agree with it.
Yeah, no, absolutely. Well said. All right, let's get to the week that was. Matt, for me, the story of the week was twofold. One was the economic data. We'll get into that in a second. But the story of the week was pretty obvious. Tech won on Monday relative to other stocks. They won on Tuesday relative to other stocks. They won on Wednesday relative to other stocks. And they went 4 for 4. Market was closed on Thursday, Matt, but they went 4 for 4. Not the first time we've seen this in the last 18 months, is it?
No, it's part of the ongoing storyline in terms of technology leading the charge. Technology has led the charge ever since the I would say mid earnings season in Q1. From that point, we've seen tech really take charge. We've seen communications take charge. We've seen the aggressive areas of the market to outperform everything else. We've seen Mag 7 and the large moats play a significant role in that environment as well. What we have not seen in that environment is a whole lot of broad-based market participation. So when you look at the NASDAQ, for example, the NASDAQ looks absolutely fantastic right now. It's in a consistent bullish uptrend. There's not a lot of weakness from a technical perspective when you're looking at the NASDAQ. It's actually, in fact, there's one thing to keep an eye on over the last 3 trading sessions that is a little bit of a behavioral shift from a technical perspective. And you can see it in the S&P, you can see it in the NASDAQ. And it's the story the candles are telling over the last 3 days. You finish strong on all 3 of those days, whereas in the previous couple weeks in the market, and you can see that a little bit more clearly when you are looking at the S&P 500, but you have a lot of battles where you have wicks up, wicks down, kind of doji fest. But over the last 3 trading sessions, once again, what occurred? Upward movement in price, closed at the top of the trading session. The next 2 days, cash open is up. Market supports it, finishes towards the top end of the candle. We've seen that over the last 3 days, and that is a substantial behavioral shift going into what we, seen this week as a breakout. And that's where I think is the most important moment, is just talking about the technical breakout that we did see this week in the marketplace. But when you are looking at that technical breakout, it is absolutely led by the NASDAQ and those very, technology sensitive names doing absolutely outstanding right now. And it doesn't look like it wants to slow down in the short term. But Mark, is that everything? And that's kind of the point. When you're looking at the last 3 months of the marketplace, NASDAQ's done great. Communication has done fantastic. What hasn't done fantastic? Well, when you look at energy, for example, over the last 3 months, pretty much, up a little bit, one short-term uptrend, one short-term downtrend, basically flatlining over the last 3 months. When you're looking at basic materials, slight fading bear market action with a little bit of neutrality over the last 3 months. When you're looking at finance, ever since finance reported last quarter, it hasn't done a stinking thing all quarter long. It's been flatlined all quarter long. When you're looking at industrials, had a beautiful trend going into last quarter. From that point on, hasn't done anything. And so the storylines in the market are relatively easy to understand right now. It's a tech market. It's a growth market. It's an aggressive asset market. But what is not participating on the growth side right now, which is for someone like you, a theta trader, really, really, really good. For a delta trader, not necessarily as much, is in the cyclical areas of the market. You really haven't had anything in the last 3 months. And so I do have some open questions going into earnings season regarding this. But that's basically what the market's been doing This week's not a whole lot of different than last week, than the week before. Technology, communications, aggressive assets, those with large moats, those have been the leadership, and the leadership for a reason. But it's not carrying everything right now. Obviously, we're seeing a lot of neutrality in the market as well. And one key point, Mark, every single week in the newsletter, we rank the markets, and we rank them from a neutral to very bullish, neutral to very bearish perspective. We put them on the scoreboard, which is a football field. And we currently have the S&P ranked right there at 30, a slightly bullish ranking. And we've had that ranking there for the better part of the last 3 weeks. Despite the breakout this week, we also maintain that 30 ranking. And it's because of everything I just said. It's a good market. It's a fantastic market when you're looking at the S&P. It's a fantastic market when you're looking at the NASDAQ. When you're looking at that leadership, it looks fantastic. But when you look at the equal weighted index, when you look at the cyclical areas of the market, a lot of neutrality. When you look at the RSP, which is the equal weighted index, a lot of neutrality. When you look at IWM, which is the small cap index, very economically sensitive, a heck of a lot of neutrality. When you look at ultra growth in ARC, a lot of neutrality, but starting to threaten a little bit of breakout in ARC. My point is, we didn't upgrade despite the breakout, not because of the viability of the breakout, although I did write about that in the newsletter. It was because we're not seeing it from a broad market perspective. It's really a specific niche area of the market. And that goes to the stock pickers market, that goes to sector rotation models. I'm not describing too abnormal of a market in the last couple of years. This is a very normal storyline we're used to when you do have that breadth and the leadership starts to take hold. The ultimate question I have, Mark, is the leadership right, or is the cyclical areas right? And I don't think that answer is going to be answered until we go through earnings season.
Or are they both right? Right? Is one being powered by an AI theme, while some of the economic worries are that we'll outline here in a few minutes in the bear case?
I think you're right with what you just said. I think ultimately that is accurate, what you just said. It makes sense to me, Mark, that in the last 3 months, when we're constantly debating the path of monetary policy, and in the last 3 months, we've had, an economic environment that, I don't want to say contraction, but it is slowing down. Would you agree with that?
Yes.
And if economically you're going to be slowing down, wouldn't you suggest that the path that the market would take is some degree of neutrality?
Yes.
And that's what we're
seeing. I hesitate. Yeah. Hey, is this actually something, right?
Mm-hmm. Well, I guess my point is, I don't think it's too outlandish right now with where the market is. Because again, I think you're absolutely right. The AI theme has been extremely powerful, and we're certainly seeing a little bit of that go on right now. But the cyclical argument is not there yet, and it's having a little bit of it's problematic to a certain extent. So I do agree with what you just said at the very end. I just wanted to add that context.
Yeah, no, and let's also talk about something that you said months ago. We've been talking about the uncertainty in the market, referring to the totality, RSP, every sector, for a long time. Tech's had no uncertainty, right? I mean, you even look at this recent pullback in semiconductors, pulled back for a few days and then just traded sideways, and not an ounce of real. I mean, there was like zero, like, oh, we have a couple down days, and then
not a lot of volatility here.
Not a lot of volatility. And so not a surprise you get a little lift off. But you have been very, on this podcast months ago when we've talked about this uncertainty, been like, unless the Fed clarifies the path of policy, the market is going to remain uncertain, referring to the totality of the markets. The path of policy still hasn't been clarified, but they haven't budged from that. And they keep throwing out, well, if we see unexpected labor market weakness, if we see a sudden economic weakness, at least a few of them, the Goolsbys, the Powells, the so forth, they so desperately want to cut, so desperately, like, and
They do. Are you a little bit more clear on the path of policy today than you were a week ago or 2 weeks ago or 3 weeks ago?
Only on the edges, in the sense that I know that they really, 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 instead of just really, really want to cut. Like, give them, like, right, like they really, really, really want to cut. Like,
I get it, but it's July, bro.
like, and so, like,
getting into the time frames and no longer hypothetical. September's not too far away from here.
And the coming week, we got inflation data. The unemployment report came out Friday, and while the headline number was strong, huge downward revisions to past headline numbers. Unemployment rate actually ticked up. And this came out on a week of some pretty less than favorable economic data. You and I were just chatting last night on the phone. And, I said, we were saying, well, like, what spooked you the most? What, this and that? The ISM services PMI number on Wednesday was really, really bad. But this is we're going to show a graph here on the bear arguments. We're going to outlay this argument more. Like, services has been a strong component of the economy for a long time now. Like, manufacturing's went back and forth, right? But I haven't seen a services number that bad in a long, long, long time. And there's some rumbling, right? There's a reason bears are starting to come out, pound their chest, right? Come out and pound their chest. And so, but the case isn't there yet, right? For that cut, is it?
I don't think the case is there for the cut yet. No, because the only case that they're making right now is the economic contraction argument, but you need to see more data on the economic contraction. You cannot take one sizable miss on services and manufacturing PMI numbers and say, oh, look, there we have the data. You got to see more months of this type of contraction before the Fed embraces that. Because again, think about it like this, Mark. How many months of us talking about the double dip inflation in early January, February, and March did it take before the Fed acknowledged the double dip inflationary situation?
Couple months.
It took right. 2 to 3 months.
Yeah, right? I mean, they in fact, we blasted them for how bad they were, just completely.
They're certainly going to acknowledge this data is the data they want to see. They do want to see a contraction, an economic environment that contracts a little bit without giving up too much, so that they can embrace the interest rate cut type conversation. I don't think they're there yet from an argument perspective. I know they're not there yet from an inflationary perspective.
And they certainly aren't there from a consensus standpoint. Like, Goolsbee was out this week, and that guy would cut right now if he had, was the only vote. And Powell is arguably, outside of Goolsbee, the biggest dove. He speaks before Congress this week. Are you gonna tune in?
I'll say no, but yes, I will.
Yes,
I always tune into. I don't tune into all Fed speeches any longer because I'm so sick of the gaslighting. I literally watch some of those Fed speeches. I'm just like, this is ridiculous. I don't even know what they're doing. I don't even understand why they're giving speeches. They never add anything to the actual conversation. But I always watch Powell, because I think it's extremely important to understand what Powell is communicating with the market and what Powell is communicating with Congress. And so I do think the Powell speeches are more important than obviously the other speeches we get. But even with Powell, I haven't seen anything out of Powell recently that would suggest that they're lining up an interest rate cut in September. I know there's a lot of market conversation in September. I know that after the labor market came out on Friday, the probability adjusted on the September hike they are expecting a hike in September. I think September's, I don't want to say outlandish, because the Fed has, in the past embraced a rate change conversation in the election season. I just think they're lying when they say it doesn't matter, quite frankly. I think this election is extremely important, and I think it's extremely important for the Fed. We know how important it is for the Treasury. They've opened up the floodgates of fiscal policy to help help that struggling economic backdrop to a certain extent. So, yeah, I'll watch Powell, but I don't think I've seen anything in the economic data that would solidify the path of policy. I still think it's a debate, and quite frankly, I personally don't think the debate is in September. I think the debate is in December.
Yeah, no, and so as long as this is just one of those, the path of policy has been very murky, and during that time, a lot of areas of the market have just basically consolidated. We'll see if earnings can give them a little bump. But before
I will tell you one thing, Mark, and I do mean this. If we would get accurate data on the labor market instead of the gaslighting we are getting on the labor market numbers on a month-over-month basis, we see these things get revised down every single month.
Well, Matt,
and that was the case this month as well, where you had last month 272,000 jobs, and now you have 218. The month before you had like 165, now you got 110. Like we're not talking about small changes we're talking about massive sizable changes. And so it's really hard for me to trust this 206. It's really hard for me.
Well, let's call it what it is. You know why it was 206? So Joe Biden with George Stephanopoulos on Friday night could say, I added 200,000 jobs. He said it. He said, I added 200,000 jobs this month. That's why the number is what it is. Let's call it what it is. Right.
The United States economy added 206,000 jobs, and about 40,000 of them will be fake coming into next month. So again, my point, it's not even on the political side of it. It's on the path of policy side of it. If you're struggling with understanding the labor market data, and there's some confusion over the labor market numbers that are coming in right now, it's hard to determine exactly what that path of policy is, because the Fed would like to see, like everybody and their dog said the revisions were good for the Fed. Would you agree with that?
Yes.
Of course they're good for that.
The totality on Friday, even though the headline beat, overwhelming consensus was this is a cut rate sooner than later.
Time you saw 206,000 jobs, and everybody in the financial world said that was a bad number.
Because people know that what the game is.
Because it's the 218 from last month, and even 218 is a good number. So again, the froth on the labor market numbers, it's a little bit too much right now. There's no doubt about that.
No, I mean, because had let's say Friday's jobs report reported 60,000 job increase, right? The Fed would be out there, and you would have speculation of a cut or at least an announcement of a cut coming up. Like the Fed needs a case. The Fed cannot just go. They won't. Whether they can or cannot, they will not unless they have an argument why they should cut. I'm convinced of that. Do you agree?
I am convinced of that. Yes, I do.
They need to have an argument to tell the markets, this is why we're doing it. They do not
have a good argument right now.
And they don't have a good argument right now.
The good argument is, hey, we're dealing with a little bit of sticky inflation, but the labor market, I mean, did you see the revisions last month? They were pretty strong.
It's a building case. It's not a case yet, though.
It's a concern, and from a labor perspective, it's a concern. For the Fed, it is what the doctor ordered. If they can get, if they could, we've said this for years, and it's still accurate today. If the Fed could have their way, they would say, give me a 4.5% unemployment rate and allow us to get back down into 2.5% interest rate to reduce the restrictive territory of the monetary.
The restrictive territory on the economy and on the debt. There's a lot of reasons that they want to cut. And it is well beyond, they want to cut to give Biden. This whatever entertaining that speculation.
I'm sorry, the refinancing issue is bigger.
The refinancing issue is huge. Jay Powell talks about the debt all the time. It obviously worries him, just genuinely.
Well, think about think about it right now. U.S. debt. Let's go to U.S. debt.org. I always love.
You love that. This is your little bear fantasy here. This is like you love.
I agree. It is.
This is your little guilty pleasure.
By the way, I do not enjoy it
in a sadistic kind of way. You do,
No, I don't. I maybe in a sadistic way, maybe a little bit. $103,509 per citizen, $266,953 that we owe in debt per taxpayer. Mark, the two of us, we owe 200. What would that be? $540,000 just based on.
Ain't getting it. I ain't paying that.
Hey, come get us. Us. But no, I mean, you look at it and you're saying, okay, that is obviously a massive debt issue. But Mark, the problem with the debt is not the debt.
It's not the debt. It's not that size.
The interest on the
that is a real issue, a genuine issue.
It is a massive issue, Mark, because when you look at the cost, think about it. And this is, they break this out now. They used to not. I love how they now break out the budget items. Medicare and Medicaid, our health care in America, costs about $1.7 trillion every year. Okay. I remember 10 years ago, I was talking about that number being $8 trillion. Now it's $1.8 trillion, but keep telling me about 2% inflation, guys. Social Security is $1.4 trillion just 10 years ago. I'm just talking off the top of my head. I don't know what the actual number is, but I'm willing to bet that number is around 700,000. I mean, 700 million.
This is the worst video game ever.
This is terrible. This is terrible. This is terrible. Nothing goes down. Everything just goes up. Defense and war. Okay. Defense used to be the number one. They're now the third, coming into Social Security, Medicare, Medicaid. $900 billion last year we spent on defense and war. Okay. America is the number one military. We're the police officer of the world. Totally get that. Okay. And we need to be safe. We got enemies out there. We need to be safe. Interest on debt, $886 billion. You know, Mark, I hear this from pundits, political pundits all the time. You know what? We've given Ukraine this amount of money. We've given Israel this amount of money. Did you see what we gave to the Pakistani, XYZ, people? We gave them $3 million. Guys, we are spending $886 billion a year on debt. That is just the interest. That's not paying down principal. That's just the interest on debt. And you know what, Mark? Look at that number. It's going up every second. And right now, a lot of this debt is scheduled to be refinanced at a much higher interest rate than what they currently are doing, which means, Mark, if they refinance at the higher level, this interest paid on debt can explode.
Yeah, and what Matt is talking about is Janet Yellen has made a strategic choice. We could do a whole podcast on this. Has made a strategic choice to issue a lot of the debt refinancing in very short-term tools, right? Hey, interest rates are going to come down, so I'm going to not lock in these longer interest rates. I'm going to do it on the short. And so there is a very strategic need to get those rates down. So, because of Janet's rolled the dice a little bit, to be honest.
She's gambling with a lot of future here. There's no doubt about that. Mark, one number to keep an eye on, this US M2 money supply rate. When you want to talk inflation, you got to talk inflation in the terms of money supply and debt, because both are used to fund, projects, money, purchasing, you name it. I've talked about debt many times, Mark. Just like 6 years ago, that was 15 trillion. Now it's 20 trillion. If you want to talk about why we have inflation in America, you don't have to go any further than just looking at the US M2 rate, which went up 25% in the last 6-7 years alone. It took us, 240 odd some years to build that, and we've just increased it in 5-6 years by 25%. It's absolutely outlandish, the amount of money that the powers that be are putting into the system. And because of their horrific decisions on embracing a zero interest rate environment, because they felt like these same individuals, believe me, they're the same people making the same decisions 10 years ago, 15 years ago. They made decisions to embrace quantitative easing and zero interest rate environments and to focus on the expansion of debt, because they didn't think in this new technological era, in this new monetary way, in the modern monetary philosophy, that they were never going to see a recession again, and they were never going to see inflation again. And Janet Yellen was proven wrong on those types of comments 2 years after she made them, and they've been wrong along the way. And now they're faced with that proverbial rock and a hard place when it comes to the interest rate and the debt. They created this debt burden, and now they're stuck with, do we want to put this debt burden back on the people, or do we want to make sure that we can refinance it? And the simple reality is people like Janet Yellen and the powers that be typically make decisions not on the benefit of the people itself, but on what is best for their institutions. And for their institutions, I can tell you one thing: they do want to lower the rate, not for us, but for this refinancing issue, because it is a major, major, major issue.
Yeah, no, it is. It is.
I think we're beating that horse a little bit, though.
No, but it's not the last time we're going to beat this horse. There is going to be a time period where I see in the future where we do like 4 podcasts in a row, to help people understand this issue, because it's going to rear its head in the markets at some point. Might not be this year, might not be, but it's going to come at some point.
Well, is there a point in time where all of a sudden the dams break and all of a sudden everybody's feeling the exact same shock in the exact same moment? I'm not sure, but it's already having an impact. It's why we're struggling with the economic environment right now. It's why we're dealing with the inflation right now. It's why we're talking about the economic stagnation right now. It's the reason why we've had these conversations on inflation and stagflation over the last 2 years.
Yeah, no, I want to transition to earnings. We still got a lot to cover in this podcast. Yeah. I got to talk about gold, though, before we move on to a little bit of an earnings preview. We have seen the last couple trading sessions, Wednesday and Friday. And if you want to know, was the market interpreting the unemployment data as dovish, look at gold. Yes. On every hot economic report in the last 5-6 weeks, sold off aggressively. It tried to. If you look at the opening minute candle on gold, it tried to, hot headline number, let's send it down, and then it was like, this was actually not a hawkish report.
It wasn't, and that's the thing. And that's the thing when you're trying to debate whether an economic number is good or bad, right? Don't go to the political pundits to describe an economic report.
Go look at yields. Go look at gold. Go look at the dollar.
Look at the dollar and look at gold.
All three traded it as a dovish.
You truth. We saw a technical beat on the labor market numbers on Friday. They beat the expectation. And Mark, we have seen those moments, and they have been very powerful. Gold goes down and then flatlines for the next couple of days.
Yields go up, dollar goes up, gold goes down.
Went down for a split second, 20 points before it rebounded right up. Same thing happened on the dollar to the downside here. Dollar and gold told the truth of the labor market numbers on Friday. That was a terrible report for the labor market on Friday. The labor market, the actual unemployment rate went up from 4 to 4.1. And again, I am so sick of the headline numbers when we know the revisions are coming.
And I think the market, for the first time, Matt, I really sensed that the market actually was like, no, this number is not real. This other stuff in the unemployment report is real. It's the first time I've sensed that. Price action certainly would dictate that. So.
Yeah, well, and again, you think about last month's revision. Went down to 218, okay? Mark, if it came in at 218 last month, would anybody have scoffed 2 days after that report? Would anybody have said anything regarding the labor market 2 days after that report?
Nope.
No, it was a good report. So we'll see. But no, the dollar certainly did tell the truth. On gold, it's going to be interesting on gold, Mark, because the price action did send it right back up into 2,400, which is obviously a known resistance level. 2 resistance levels you want to keep your eye on when it comes to gold: the 2,400 number and then the double tick at 2,450. Ultimately, though, both of them can work out through pattern development. Any consolidation at 2,400, any consolidation at 2,450, both of them would be breakout type scenarios. But like you said in the newsletter, gold does remain our one instrument in the entire world where if you do not have a position, well, it's
yeah, and this has told a really nice story, as it has for the better part of a long time. Wanted nothing to do with sell-offs.
Honestly, Mark, do you remember my prediction on gold last week?
I don't.
It was, I didn't predict anything. I said one scenario where I think you could see some price action is a violation of 2,300. And that was based on the philosophy that labor market beats and it sees a quick volatility to the downside. I thought we were going to see the rinse and repeat of the patterns we've seen over the last month or so with economic beats, down on gold kind of stabilizes, down on gold stabilizes. Man, the market sniffed that one out in literally 2 minutes, Chuck.
Yeah, markets are
don't argue.
There's a reason. Friday's price action is why market technicians will say price is king, queen, and country, right? Like it's like don't overthink it. What is the
when you say technicians? This technician says that.
I know. Yeah, I was giving you a softball.
Yeah, I was just saying that's not every technician, but price is king, queen, and country. It's everything. The price doesn't lie. And I say this all the time about technical analysis. The number one reason why I love technical analysis above all other forms of analysis, and I don't think technicals is the end all be all, and you never have to understand behaviorals or economics or fundamentals. I love all forms of analysis. I think all analysis can give you what you crave as an investor and a trader, and that's an edge in the market. But technical analysis is the one that tells the truth. And that's the key point. It's not what somebody says in the market. It's what somebody does in the market, because what they say doesn't impact on price. What they do has an impact on price. And so, yeah, I do believe that technical analysis is king, queen, and country. And if you want to learn how to read a chart like I do, I am teaching an upcoming Master Trader class on the 15th and 16th, where you can sign up for free because we love our community of the Trading Justice podcast.
Prioritize gold if you don't own it right now. Let's head into our earnings preview.
Every day. Yeah.
Like it's just like I hit it for some theta on Friday. We'll start the week. I'm like, oh, I don't have enough exposure. I got blown out. It's just a good place to be. All right, I'm going to transition into a little earnings preview. One of the things that I'm very grateful for, and I give Matt a lot of crap a lot of time, call him a left brain nerd, this and that. But I am very grateful, and I joke sometimes that I don't have to do work on this subject because Matt does it all for me. But I am very grateful on a very important subject to have an expert in the family and have an expert in the community on earnings. Matt does a fantastic job, not just on the micro level of, hey, what did a company report, what it did, but understanding the themes. And if you followed Matt on earnings over the last couple earnings sessions, he's made some amazing calls. I mean, he like the first quarter, he talked about in the industrials, how they were beating expectations slightly, but the price action, and he was calling the price action. He's called the price action. He's like, oh, this thing on Meta, this sell-off on Amazon in recent quarters. He's like, it's nonsensical.
Yeah, I did call those the last 2 quarters.
Like you made some,
yeah.
And I think one of the reasons you're able to understand the price action so well is because you are an earnings expert. And so when you put together a little preview, which you did in the Tackle Trading newsletter this weekend, worth the price of admission as a pro member. It's just an amazing newsletter. But when you put together a little earnings preview, someone like me who is not an earnings expert, who does not literally 2-3% of the time that you do into earnings, I'm going to, as a consumer, sit back and I'm like, all right, what's Matt looking forward to? What are some of the questions on an expert's mind as we head into an earnings season? Because I'm always curious, because like sometimes we joke it's the most important earnings season in the history of the market. Is it an important earnings season? Is it not? Like, like what's the themes? Like these things matter. They matter, and they from a trading point of view, from an investing point of view. So with that long introduction, which I hope wasn't badly. I mean, I said several nice things about you.
Listen, I didn't say anything. You were saying nice things. I was just like, keep going, bro.
Matt, you post 3 questions in the newsletter that you labeled key questions for this earnings season, right? And so I'm going to ask the questions, pose the questions, and talk about why you had this as a key question. First one: has concern about the U.S. economy and labor market softening led to downgrades in earnings forecast? Why did you label that a key concern?
Well, kind of going off the first little bit of our conversation in the podcast, talking about the slight economic contraction we have been seeing in recent economic data, and has that economic data led into, concern on the consumer, which has ultimately led into the projections on EPS, and have those projections been revised lower in the face of some concerning economic data. And when you're looking at earnings revisions, first and foremost, earnings always get revised to the downside going into earnings season. If there's one thing I know beyond anything else in the market, is that the market loves a low bar. And
it's the game.
They love establishing a low bar so that 75%
and I love it when bears complain about this. Like, hey, it's just cheap. They always, but accept it.
Yeah, they cheat, and then the market adapts and becomes efficient, and we understand they cheat. And so instead of looking at the beat percentage, we look at the beat percentage on EPS. And so, for example, Mark, you're absolutely right. But this is where the bears get it wrong. Yes, 75% of companies beat the expectation. And yes, 75% of companies beat the expectation because the bar gets set lower. But no, the market does not always just simply rely on whether or not the company beat or missed. It's based on the beat in comparison to the percentage beat. That's the important thing. And so the bears, I just find most bears to be very lazy when it comes to actually establishing well thought out bear arguments, quite frankly. And that would be one of those situations. But to answer the question, Mark, we always see revisions. So the question is, are we seeing more revisions or are we seeing less revisions than what we
so basically see? Does it become a theme? Like, do we have enough downward revisions where people start talking about it? Is that what?
Again, in earnings circles, we're always talking about that. That's never going to be a theme because it is a cliche in the market. Does that make sense?
Okay.
It happens every single time. The ultimate question is, and again, we're trying to establish in this question, where is the earnings bar set? Is the bar set at a high standard or is it set as a low standard? Is the market getting into a moment where they're just going to embrace any beat like we started seeing in the first quarter, or is it going to be a little bit more of a higher bar?
Okay, I see why
it's really about.
So basically, the bar is one of the highest bars we've had in a while.
Yes, and that's the thing that I'm.
So these are not the low bar expectations that we have. So there's actually some. Okay, and so I see what you're saying with this. So basically, if you beat this quarter, it's pretty legitimate.
You beat this quarter, a beat this quarter is more important than a beat last quarter
because the bar is set much higher.
Yes.
Okay.
Yes. And so I'm trying to understand the bar here, because if I don't understand where the bar is set,
okay, I see why. Okay, I'm getting it now.
It's very difficult when those companies come out and report to be able to determine, oh, is that a good market response? Did the market get it right? Did they get it wrong? And if they got it right, where's the next movement? And if they got it wrong, like they got on Meta last quarter, or like they got wrong on Amazon the quarter before, it's easier to call that out in the moment when
those were fantastic
bars are established in the first place. Does that make sense?
Yeah, it does. Okay. So we got a high bar.
So, right? Yes. Well, not only do we have a high bar, Mark, because the bar is established both technically and fundamentally when you're going into earnings. And so if the market is at a higher point technically, and the earnings revisions do not contract as much as we typically do see on average, on average, I think earnings contract about 3 to 4% going into earnings season. Right now, we're contracting, depending on your stat, about 1 to 2%. And so that's the fundamental bar. The fundamental bar is high going into earnings. It's high going into earnings for two reasons. Number one, the earnings revisions were not as much to the downside as we typically do see. So that's number one for the bar being set high. The bar is also set high due to valuation right now. The forward PE ratio as we're starting earnings season is at 21.2. A 21.2 forward valuation on earnings going into earnings season is a high bar. You are above your 5-year average. You are above your 10-year average from a valuation perspective. So the earnings revisions were less than anticipated, and the fundamental condition was a higher valuation than we anticipated going into earnings season. And so based on that, the fundamental bar is set a little bit higher than normal. And then on the technical bar, I always see this from a performance perspective. Same numbers, same everything, no changes in guidance, EPS, revenue. If a company has been front run going into earnings, a lot of times it will give up that front running status. If a company is at the low point on the chart going into earnings, a lot of times it will get the gift of the gods to a little bit of an oversized price movement to the top side. And so I'm trying to firmly establish where the bar is set. And from a fundamental and a technical perspective, we got a high bar going into this earnings season.
Does that cause you some worry, like just from a tactical standpoint?
It does. It's a cautionary tale.
Because the plain and simple fact, I'm here like listening to you right now, like I'm a podcast listener.
You better beat.
Yeah, and I'm thinking, I'm trying to remember. I'm like, when's the last time we've had a bar this high? And I'm like I can't think of any, like the last one, maybe 2021, right? But
I think you can go back to 21 and make a lot of compelling arguments in 21 versus 24.
So you got technical, fundamental, valuation, and now you have high earnings expectations.
Can I also add one last thing to that? Because if you've established the case that the bar is high,
which I think you have,
these companies need to do good to continue to advance. It's also one of those situations where you might want, if you have long-term investments and you have a high ceiling that may not be able to, get over, you might want to look at some risk adjustment strategies such as protection.
Okay.
On long term.
Protection is cheap. It's like they're giving it away at a Walmart as a special right now.
But that's the beautiful thing about it, about protection in a bull market, to protect against uncertainty or unexpected volatility. It is cheap to insure, and so
it is you are it's just insanely cheap. It's just like, here's some.
And again, free. I'm not saying go out and rush and buy put options on the S&P 500 despite the bullish conditions. I'm saying if you have an individual stock and you are,
but on your individual stock,
yes,
yeah, because Matt, we have seen in the, I kind of like look at it as like the off earnings season, right? Where you have the Nikes, the this, the that. We've seen some companies gap down 20%, right? Like, in the individual stock basis. And so
and Nike didn't have a high bar. Like I'm talking about market mechanics. Individual stocks, you would have to apply it individually.
Obviously, let's think about PenW, Meta. We've seen some pretty big move down in some real blue chip stuff in the last, on earnings.
Every company is an individual story. The macro conversation is a collection of the analysis of 500 of the largest companies in the world. Nike was a consumer related concerning miss, and rightly so. Nike didn't do good. In fact, Mark, Nike had a low bar and did worse than the low bar, which wiped out any bullish analysis on it, quite frankly.
Yeah, no. So, all right. The second question you ask in your earnings preview deals with blended growth. This is something that I've come to appreciate quite a bit. This is the fundamental metric.
That blended growth conversation.
Yeah, no, this is the thing. You have I don't even look at other metrics. I use blended growth.
Number one macro earnings metric I love.
And you love it. Just to give you the earnings for dummies recap, you believe that it provides the best story of truth, right?
Mm-hmm.
Like
it provides the best understanding of the improving or deteriorating condition from the beginning of earnings season throughout how we navigate earnings season. So, for example, Mark, last quarter, we were dealing with the first week of earnings season was not a good week in earnings season, and we saw some pretty nasty selling as a result to it in the financial space specifically. And then you had two healthcare revisions come out on Bristol Myers was one of them. Gilead Science was another one. You had two big healthcare revisions in the first week of earnings last week, and it went down from three. The blended growth number went from where we started earnings season at 3.3 in the first week and a half, went down to 0.5. And at that point, like, it was everything. It was a fight back up just to get back. And Mark, when you look at the blended growth number and you look at, say, the RSP, for example, which will help us understand the weighted, equal weighted index. When you're looking at that, Mark, here was the trend going into earnings season. Here's what happened at the very beginning of earnings season. And what we've seen throughout the next 3 months is a bunch of consolidation and stagflation. Well, Mark, that was because when you look at blended growth, it was 3.3% last quarter. The average improvement of blended growth, because we know the company cheats, so we have to figure out how much do they cheat. The average beat was about 8%.
And this is why you love blended growth, because it tells you truth.
They can't lie about it.
They can't lie about it.
They can't lie about it. We'll figure out the next metric to figure out their lies. And so that we know they're going to beat, but what percentage are they going to beat? And the veracity of that beat becomes the ultimate importance. And so the blended growth went from 3.3 down to 0.5%, and it was a fight back up to get into the mid fives, which means from a totality perspective, Mark, we started at 3.3 and we ended into the mid fives. The standard improvement is between 6 and 9% regarded when you're looking at the 5, 10, and the 20-year averages on percentage beat. And so you needed to get into the 8, 9% growth to make that growth argument. And you just didn't do it from an earnings perspective. And what have we seen in the next 3 months since that occurred? We've seen stagnation, neutrality in almost every single cyclical area of the market. And we've seen only trending conditions in AI related growth in the market, which means the market lost its growth argument, not today, it lost it 3 months ago. And now we need to go through that again.
And you said in the newsletter, blended growth is once again, high bar, 8.8%.
It's the highest in the last 3 years since 21.
And so, I mean, there really is, this has the feel of a, like different earnings season just because of the expectations, right?
I'm a little surprised they did not revise their expectations lower, given the fact that they do have an economic argument to lower their expectations, and they did not. And so, yeah, I do think you got a high bar going into earnings season. You have a high bar in almost every single metric going into earnings season.
Yeah, no, yeah, very, very, very.
Now, by the way, actually, I'll answer this in the third one.
Because the third question you ask in the newsletter are what themes are emerging this earnings season, particularly regarding cyclical versus aggressive. Now, are we looking at price action here? Are you looking at raw results? Like, talk about this one.
On the third one, what themes are emerging? Okay, we all know the divergent story between SPY and RSP.
Yeah, right? We're going to talk about it in the bear section. Bears love it. They lead it. They have banners. They got poster boards. Right.
How long can two stocks carry the entire market? How long
S&P 7. Like, how many versions of the S&P 1, S&P 5, S&P 7, right? Like,
we all get it, right?
We get it.
So I do think
they're funny jokes, actually.
They're very cute. And so, but I do think one theme that could emerge early on is regarding the cyclical areas, because they truly have not done anything in the last 3 months. A lot of neutrality, if not fading down bear trends. Mm-hmm. So you've had a tremendous amount of separation year to date between cyclical and the growth areas. Okay. And in fact, let me pull up a FinViz chart very quickly for those listening on the app. I'll describe it. when you go to groups on FinViz, you can kind of see the performance. All right. So half year performance, for example, technology is up 34% on the year. Comm services up 29%. Everything else is 4 to 10%, right? A wide difference in performance. But Mark, when you look at the last 3 months, it's tech and comm services and nothing else. When you look at the first 3 months of the year, for example, and you look at the trend in the S&P, just a very consistent trend in the S&P, that was an all everything trend in the S&P, and it was one of the more consistent trends we've seen in a long time. But that's what all everything trends do. They're very consistent. From the first quarter reporting season until today, the trend of the S&P 500 is bullish. It's certainly bullish, but the trend of RSP is not bullish since that time frame. In fact, it's wide range neutrality right now, which means you've had massive separation from the leadership of the marketplace, the technology, the communications, the Max 7s, the large moats. You've had a lot of separation there. My question regarding themes, and this can work both ways, by the way. My question on themes is, does the divergence improve basically? And that improvement can happen in a couple different ways, Mark. Number one, let's say the high bar is let's say in 4 weeks from now, when we're looking back at earnings season, the first 2-3 weeks of earnings season, is that high bar justified? If the high bar is justified, meaning these companies come in at expectation and the improvement in blended growth goes from the 8.8 to 9 to 10, and we start to see that improvement over time, doesn't the argument at that point become, listen, cyclical catch-up storyline?
Yeah, like you floated this to me a couple days ago, and it makes so much sense, right? If earnings delivers and I think this is key, right? Like you painted a good story with these 3 questions.
Yeah.
If the high bar is set,
which it is,
with some economic worries in the background, and it is surpassed, it makes sense for a cyclical catch-up story.
Okay,
right?
So in the scenario 1, where the high bar is exceeded, Mark, a lot of that positivity is already priced into companies like Apple and Nvidia, and
you could see consolidation
and like that. Those areas of the market have been trending for months.
Right? They've been trending. So you can see them take a break. This is the 2021 story. So like if we create these parallels in earnings to 2021, last time we kind of had higher expectations. The last time we were putting back-to-back consecutive positive earnings growth stories, that was the 2021 story. 2021 was a story of rotation. It was a story where things took turns, right? And it just, this time, there's a whole lot of things waiting to take their turn. Right?
Now, in the scenario where we get a similar reaction to last quarter, where you basically come in at expectation, yes, you do a slight beat on blended growth over time, but nothing outlandishly positive on the horizon. Don't you see a scenario where in that environment, cyclical maintains neutrality and the leadership comes down a little bit?
Yeah, I mean, that would be just a logical way to react to
that,
right?
And then in the third scenario, let's say earnings completely craters and doesn't come in.
So and define crater, like growth comes in at 4.2% instead of 8.8. Like
blended, anything under 8 would be disastrous, bro.
Oh, really? You think the bar had said so high that like, because I throw out a 4 as an outlandish, but you're saying like even like
you're
6.
comparing it against first quarter to second quarter. I'm comparing it to year over year. And if you're going to contract year over year, that's not going to be a compelling story. Think about it. If you're going to contract year over year, what's every one of those revenues that I'm reporting on the individual components? 3% down year over year.
Oh, wow. This really is high. Like, Matt, I honestly, in listening to this, I did not really realize how high the bar had been set.
Bar set high.
Like, I'd seen some anecdotal things. I mean, this is, to be honest, not to be glib or it's not,
Yeah.
This is why,
4-7.
like, this is why you tune into experts talk about their subject matter, right? And so
let's say the scenario where it comes in at 5% growth, okay, which is still better than the last quarter, but worse than the expectation. I see a scenario in that where Max 7 comes down and probably a slight downward drift on cyclical. Mark, if you actually think about what I just said, in all three scenarios, the divergence gets better.
that's a massive takeaway, bro.
I know. And I don't know how I personally I know what I just said.
That is like a, oh my gosh, like that is a massive refuse to issue a comment because the statement posed is so profound that I need time to think.
Okay.
Like,
do you remember the last time we were divergent this bad on the RSP versus SPY? It was earnings season that aligned that again. So, and I wrote about that 3 weeks ago. Again, I know what I just said. I don't know how I personally feel about it yet because that's not what I'm seeing technically. And I anchor so much technically, but it doesn't make sense, Mark, that the most likely scenario coming out of earnings season, whether or not we're talking about a bullish response or a bearish response, is that the divergence conversation improves.
yes. Based on the logic that you just put forth.
And again, technically that's not what I'm seeing. But when the bars get established that high going into earnings, like you can see a little bit of thing. I think this earnings season, we reset the technical backdrop of the marketplace, honestly. So I think it's an extremely important earnings season. Mark, when was the last time you heard me say this is the most important earnings season?
No, you're not. I'm the radical brother.
I said that a lot in 21 and 22 post-pandemic.
You did. You're taking a few years off.
Specifically in 22, I said it a lot because 22 was a really important earnings story. But I haven't felt that about recent earnings seasons as much. I feel like this one is an extremely important one. It's going to establish, obviously, every earnings season establishes the trends of sector rotation models. But this one is so important because at no point if we went into this one with the breadth of the market as large as it is today. And so I think it's extremely important. And I think the most likely scenario that results is I would say, if I had to say right now, I would say we improve on blended growth. And again, I'm hesitant because I'm not solid on the analysis, Mark. I want to see some of those banks report first. But if I had to say the most likely scenario post-earnings season, talking in front of earnings season, which is not in the cards in any capacity right now, is a cyclical catch-up story.
Yeah, cyclical catch-up story. Well, that would a lot of individual trades, and if that plays out, your trading screen is going to expand in candidates, and that's not a bad thing. My biggest beef right now with the market is that the tech trade to some degree feels like one trade, right? Like it's like you got these handful of companies that are all doing great. The technicals are great. On the lounge on Friday, we're looking at charts and it's like, oh, that's a great setup. CRM, that's a great set. And I'm like, yeah, and they're all like trading like
they're all trading on the same theme right now. They're all,
it's like it feels like it's one trade, and which is great, right?
Well, it kind of is. It's not just one trade because you got to include Amazon and Tesla now in that conversation. But I understand what you mean because they kind of move on the exact same gasoline.
Yeah.
Right. So, but isn't that's the cool part about earnings season though, Mark, is that right now there's kind of two major storylines. Three major storylines in the market. Number one, you have the, when is the Fed going to cut major storyline? Number two, you got the softening labor market, softening economic condition. And then number three, you got the AI storyline. The first two are a little bit concerning for the cyclical areas. The third one is obviously a very powerful growth argument in the market. what earnings season has the tendency to do is reset these conversations, is to reset the technical backdrop, reset the conversations we're having on the marketplace. And so I'm looking forward to this earnings season. Talk to me in 4 weeks. I'll probably not.
No, and we will so this is a very interesting stage Matt has set. And I would talk more of it if we weren't already running over on time. But we will paint this story developing. Yeah. It's nice thing about earnings season is that you get this week by week development of the story. And one of the things I like about it from a thematic trading standpoint is, I get to see the story develop a little bit. I don't have to act until it becomes compelling, right?
Well, and here's the thing: in the newsletter during earnings season, I usually write 3 articles in the.
We're going to spend a lot of time on earnings. There will be a lot.
Well,
and Matt does this fantastic.
Hold on, Chucky. Hold on. It's not just that. I will have graphs in the newsletter that you will be able to track the week-to-week progress on these big conversations, such as blended growth, the percentage beat, the percentage revenue. I'll add a little bit more than I did last season as well. I'll have my quick hitters, the earnings beats versus the earnings misses. It's going to be absolutely fantastic.
And Matt does this great thing called quick hits in the thing. It's my favorite little thing. I love it.
I like quick hits too.
I like quick hits. All right, let's get into some bearish fantasy. Right. So turning down the lights, relax in your chair. If you're a bear, we're going to give you some bearish arguments that are out there. And Matt, there have been listen, I consume probably more, what would be the right word? Non-mainstream media sources. That's a clever way of saying message boards. Yeah. Than you do. I go deeper into the dive of the financial underbelly than you do. In trying to get, but it's not just message boards. I'm seeing it in a lot of well-known bears. David Rosenberg is a real big equity bear. A lot of people starting to run their mouth a little more. A little bit mouth. You're starting to see bearish arguments more prevalent out there. And so we thought it would be, because you might be seeing those too, right? Where it's you see this headline, S&P gonna go down, 8,000%.
We all see bearish opinions on every social media channel, financial media. We understand, we get it. Let's since we're at the tail end of the podcast here, Chucky, let's go 2 minutes per argument, and let's rank them from a viability perspective.
So we're going to give you
how do we want to rank? 1 through 5, 1 through 10?
Dude, it's 1 through 9. I don't care.
Okay. 1 through 10. 10 is you're ultimately worried about that. 1, you have zero concern about that. All right. You make the case, we'll rank it.
All right. And so we're dealing with, we'll deal with these one at a time. And this is one we've already referenced here in the podcast. Listen, this is the S&P 1. This is the S&P 7. This is the just a few stocks. This thing is just a favorite of the bear arguments. Now, the one.
What's the what? List out the argument so the
the basic argument here is that, listen, when you have had these historical extremes in the past, when the market is narrowly led by just a few companies, that has not ended well. That has not ended well.
The argument is the narrow breadth of the market rally. Okay, I just wanted you to say the title for people that are listening who have zero clue what you're talking about.
Sometimes I don't look at your screen because sometimes it distracts me because I'm a very simple man.
I just want to make sure that the listeners.
Okay, so I see what you're doing. Yes,
you were ranting on things that I'm like, well,
I was assuming you could see the screen. Yes, I was assuming
most of the people that
you're right
taking the news in the Trading Just podcast, they listen to it, they don't watch it.
I know. Listen,
I just want to remind you every now and then because you were talking like
I did. My bad. Mea culpa.
I was worried about everybody that was listening to it.
Like the narrow breadth of the rally. This market is only being led by a few stocks. And, the basic bear argument here is twofold. It makes the market increasingly fragile if something goes wrong with a couple stocks. And then the chart they love to share is that the times you've gotten the most extreme like this in history was .com in 1929. And that is going to invoke every bear fantasy that there ever has been. When the current situation has a parallel to 1929 and .com, that's going to excite bears, and so you're going to see this argument out there a lot. Are we ranking this 1 to 10, Matt?
Yeah. So how concerned are you with the overall breadth of the market rally?
Yes.
Okay.
Now, do you want to go first, go second, and we'll take turns?
I'll go second on this one. You go first.
I'll go first. This one's like a 2 for me. The breadth argument actually makes sense to me, right? You have the most powerful theme I have ever encountered in the market, AI, and it is being led by nation states. The nation state of Apple, the nation state of Google, the nation state of Tesla, right?
Amazon.
These if there are going to be winners, yes. Are there going to be individual stories that emerge in the next 5-10 years that you're like, oh, I didn't know about that company, and now they're sure, yeah, that of course they are. But who's the sure money in this, right? Well, it's the nation states, right? It's the nation states, and so this is not .com. This is 1929. These companies have balance sheets and their own economies the size of countries.
Well, yeah, but is that the concern about those companies coming down, or is it the concern the concern regarding will this equate to a bear market?
Yeah, well, yes. Do I think that if
Mag 7 goes down aggressively, does that create a bear market?
If the Mag 7 went down aggressively, would that create a bear market?
Yeah.
Well, they're the generals. Yeah, no kidding.
Yes, if the generals went down 20%, yes, we would have.
Yes, no kidding. Yes. Okay. Now, does narrow breadth cause?
How concerned are you in the breadth of the market?
Of it causing anything permanent, a 2. And if the question was
on that,
yeah, if the question was phrased, is this likely to create more market hiccups? I'd be like, yeah, 7 and 8, because everyone's piling on, and that can create positioning things that create little market spillovers.
I think I need to teach people about what sector rotation models are. That's all this is. Yeah, you want to talk about the AI theme, all it is sector rotation models. Technology and communication are a little bit overextended right now. Those are where a lot of the AI names kind of live, as they're a little bit overextended. Fundamentally, they're overextended. Technically, they're overextended. Guess what? The next time we go through a profit-taking session and those companies go down 5 to 10%, that money's going to flow into cyclical and shore up the cyclical side of it. And so, no, I don't have concern about this specifically creating.
And it's a popular one, though, Matt. It's out there. People love it on social media.
Yeah, of course it is,
because it's dramatic, right?
Yeah, but it's not
like, how can it be a real stock market rally if only a couple stocks are participating? And yet it's not illogical to me, especially when it comes in from a sector rotation understanding, right? So
I'm not concerned about it.
Yeah.
Am I concerned about the narrow breadth in the short term? A little bit, I think, but that's also why I think we're going to see some rotation into cyclical.
But from a bearish market,
because again, if the leadership falters in any market condition, of course.
Yeah. So
of course, but
so it does not sound like either. And Matt and I did not. No, we did not practice beforehand and get each other's answers.
Mark sent me his notes and I put them into slides.
Yeah, so we do not know each other's concerned. Zero idea, and so it doesn't sound like either one of us is very concerned.
Let's rapid fire that one. That one took 7 minutes and we didn't have any concern.
Consumer finally cracking. This is one where you have had a lot of statistics out there, and this is one that is starting to gain some steam and traction, where you start to have big banks talking about it, basically pointing to a variety of different statistics, whether it is savings rate at 16-month low, whether it is retail sales numbers, whether it is disposable income growth, whether it is credit cards maxed out. You got a lot of statistics, and you have corporate earnings announcements where companies talk about it, where that are increasingly discussing consumers in trouble, consumers stretched, consumers this, consumers that. It's getting a lot of discussion right now. Matt, I went first last time. How much concern do you have on this one?
The consumer has been the backbone of the U.S. economy, and honestly, the reason the markets go up like this, because if there's one thing we know about the consumers is they like to spend their money. And post-pandemic, they had a tremendous amount of money saved up, not only from the pandemic and all of that, but from a decade straight of zero interest rate prices that drove housing prices up, retirement accounts up, you name it. Just the biggest financial boom we've ever had is in 2010, from 2008 to 2020. And so they had tremendous strength going into the pandemic, and they had tremendous strength with all of the fiscal and monetary policies that we were applying at the time. Mark, they're starting to get tapped out. That the savings is running dry. They're getting maxed out on their credit cards, and about 70% of the American workforce right now is paycheck to paycheck. But the reality is, as long as those paychecks keep coming in, and as long as the wage growth is on top of the CPI report, consumers are going to have money to spend, and they're going to do what consumers do. And so, am I concerned about the ability for the consumer to do big purchase items? Absolutely, I am. Am I concerned about the consumer to continue to spend money on the standardized 10 to 12 bills that we all have? I'm not as concerned there. And so the only time I'll get ultimately that concerned on the consumers if they're losing their job. As long as they have their job and wage growth is exceeding CPI, I'm not going to be outlandishly concerned. But I would say I would rank this as a 5.5.
Yeah, I'm probably a 7 and 8.
Yeah, I figured you were higher than me on this.
Yeah, I did. I mean, one of the things I worry about is that inflation has been so bad, and that it's the credit card data that in particular, where it's like, how much are people really running on fumes? And as far as the analysis you gave, I'd probably be the same, 5.5. I'm really concerned if you do have companies pull back, right? And so it's one of those things that, at a minimum, well, where you're going to see what we've seen, a choosy consumer, a selective consumer, right? We've seen winners in consumer discretionary. We've seen losers. I think that continues for sure. It's just, if something tips the scale, so to speak, I worry that the consumer is not in a position where it's not going to greatly affect. So probably 5.5. But I think in my heart, I'm like a 7 and an 8. My brain's a 5.5. My heart's a 7 or an 8.
I can't disagree with that at all.
So number 3, the effects of the interest rate lag. Now, and Matt, I think this is the one that's really increased the bearish rhetoric lately, because you have had this graph pop up all over the place continuously in recent weeks, as economic data has not come in hotter than expected. It has been a weak stream of economic data versus expectations. And so it is creating this very red graph, right? Where it's like, oh my goodness, if you have a red line that bad, it must be terrible out there, right? Just, this has been, and I think this
this is not economic data. This is economic data in comparison to expectations.
Yes.
Okay.
But and we covered this in the newsletter a couple weeks ago.
If ISM PMI numbers are expected at 53.4 and they come in at 53.3, that would be red. It's a good report. It would be red. I just want to clarify that.
But it's still, but you've had this string, and it's created the weakness in versus expectations, and it's starting to get a lot of chatter, and not just from bears, but from economic analysts like Mohammed El-Arian, right? A lot of people are talking about it. And Matt, it plays into, and this is, because bears got this one completely wrong. Not just bears, but economists predicting recession in 2022. Maybe your best contrarian call I've ever heard you make was at the end of 2022, where you're like, there's not a recession coming. That was like, you did it on this podcast. I was here. You made the call. You were right. The best contrarian call I've, because that's a good one, because everybody
projecting a recession
was on a recession. And they were on the basic argument, right? You raise interest rates this fast, right? Well, eventually there's going to be a lag effect where it starts to show up in the economy, right? Well, in the economy. Well, that's starting to come back, right? It's been dormant. Nobody's been using that for 18 months, but you get a string of economic data come in weak.
How concerned are you?
This year?
Yeah, how concerned are you on the interest rate lag impacting EPS, revenue, and ultimately the market conditions right now?
I think this goes to your conversations you and I have, that if I was left in a bubble, I would probably be like an 8. Because the argument resonates with me on the interest rate lag. But it also it resonated with me in 2022, right? But when you and I are just chatting markets, and you and I are chatting markets all the time, it's like, well, how many times are people going to bring up the same argument and you give it credence? And so the consumer thing scares me. This one does not, because I haven't seen terrible numbers. I have seen numbers below expectations, numbers that I haven't.
What you've also seen is in the last year and a half, where everybody was proven wrong on the recession due to interest rates, that the market has, and I'm not talking about price appreciation. I'm talking about from an EPS revenue.
No, because people were predicting an earnings recession.
The market has proven to withstand a 5% interest rate.
It has.
And
it can adjust.
And so am I going to be outlandishly concerned on the effects of the interest rate lag when the market has proven to withstand a 5% interest rate in and of itself? No, I'm not that concerned here. This goes to what I call the path of policy. As long as the path of policy is unconfirmed, you have ceilings based on the interest rate conversation. It's not really a concern regarding the lag of that, although that's an important point as well. But I do think it's just the simple understanding that as long as there is no clear path to the monetary cut of interest rates that the market has understood, there is ceilings on the cyclical areas of the market specifically. And so do those get alleviated? Maybe, maybe not, but I wouldn't be that concerned on the interest rate lag effect as of right now. Is it a concern? Certainly, but so is inflation.
But doesn't it feel more grindy, mediocre growth than anything?
It feels like we've all accepted the fact that 5% interest rate sucks, and it sucks, but we're not dying over it.
Yeah, I mean, it's just grindy, winners, losers area, type thing. But the gray bear. But I swear that graph's getting a lot of things. All right. One of the amplifying effects, right, is that, well, nobody's expecting a hard landing. So if it shows up, everyone, well, I think you got to see it. I don't know. There just hasn't been that economic report. That's great.
On the lag effect, I would put it as a 3. Right.
Oh yeah. I don't think we officially ranked.
Yeah, I'd put it as a 3 on the lag effect.
I am particularly susceptible to that argument.
I know you are, but isn't there more forward-facing arguments now?
Yeah, no, but I've had to go into rehab on that argument, and so coming out,
I never had to rehab that argument. Yeah, I never embraced it. So,
coming out of rehab, I'm going to put it a 4. The consumer one scares me. That's the one.
Consumer one is a bigger deal.
Yeah, that's the one, especially because
the consumer's tapped out and they can't go to the debt to do anything at 5.5, because that means credit cards are 22.
That's the one. All right. Okay. Number 4, stocks are not.
So far, it is the consumer one that is the biggest.
Yeah. The other two, I'm pretty brushing off. It sounds like you are as well.
I'm brushing off. Yeah.
And we went through and we tried to compile what are the ones the arguments bears are making the most.
It's not that they're not compelling arguments, and it's not that fact that they're not good debates to have. It's that I just don't see a lot of short-term impact.
You know what's funny? If you and I sat down, we could have come up with a much better list of the things that we could creatively see as problems down the road.
Oh, yeah, well, that's the thing. You want to talk about things 2 years down the road. That's a bigger list, quite frankly.
Yeah. Right. An oldie but goodie, the most significant, as far as offside. and I was telling you this before, Matt, stocks aren't cheap. Valuation is too high. And every bear argument I read out there, nobody spends an inordinate amount of time on this point, but they always use it as a backdrop point. Yeah. Here is my main argument, and it is also in the backdrop of stocks not being cheap, right? And then they'll point to some measure such as GDP. Well,
people don't have concern when the PE ratio is 14,
and so now,
so stocks are not cheap right now. How would you rank it?
This to me is a 1. I don't know if I was supposed to go first or not. I have.
We'll definitely disagree on this one. Give me your quick take rationale on why the 1.
In 17 years of doing this, I have never seen stocks go down on valuation.
Now they will never go down on valuation. That will never be the case.
And so can it be an amplifying effect if something else goes? Sure, 1,000%. Absolutely, right? But but I'm looking for those other things.
People don't sell their stock because they bought it at a 14 PE ratio and they achieved a 26 PE ratio. That's not why they sell their stocks.
No, and so if something else goes wrong, but that also is because things will be technically stretched in that scenario, blah, blah, blah. And so I just don't spend any time thinking about it at all.
All right, it's an important metric for me in terms of how
because you're more left brain on that, right?
It's an important metric for me because it will help me interpret the data that's coming into the market during earnings season. It goes to the high bar type conversation. I mean, when you're talking about a market that has a Shiller PE ratio that is currently the 3rd highest of all time at 36. It has a current 29 PE ratio, which is the 4th highest of all time. And the forward PE ratio right now is 21.2, which is higher than the 5 and the 10-year average. I am more concerned about the short-term valuation on the marketplace than any single factor that we have talked about, including the consumer. But that's because we're going into earnings season. If we were doing this podcast 6 weeks ago and you were talking to me about 36 PE ratio, I want to care less about it. But you're going,
but because in the context of what you see this high bar that we talked about, in the context of that, it has an extra emphasis. Very interesting.
It does.
You're such a quant.
So I would rank it as I want to put it. Yeah, I would. I'll put it as a 6. In the short term, I got.
Oh, wow. Is that your highest ranking?
It is. In the short term, I am more concerned about the current valuation. The current valuation absolutely has to be justified based on earnings. It has to be justified based on earnings. If it's not, we're not talking about a market that's going up after earnings.
If you dive deep, which we will not right now, the emphasis we put on those tells us a little bit on our approach to the things we value as important. I find that interesting. I find that very interesting.
All right, number 5.
It doesn't surprise me. Multiple expansions, right? And this is one, in some version that is thrown out where it's listen, earnings are essentially the same that they were a couple years ago. The market is higher, but really, how much have we grown if the earnings are basically the same that we've had in 2021? This is only a multiple expansion. It's not a real market, right? And this is one this is not my area of expertise, right? I am not dive into the thing. I immediately got your take. So this was one thing where I did know what your answer was in advance. Mm-hmm. Talk about why you hate this argument so
because if you look at the earnings results from 2010 to 2015, they came in at 110 versus 114 for those 5 years. And if you were to rely on that argument, earnings wise, you'd missed out on one of the biggest expansion areas of the market in the history of the market. So I think it's a very faulty argument when you're looking at the EPS, because the argument goes that EPS has not grown significantly since the pandemic.
Yep.
And they're right, Mark. They're absolutely right. But they're also cherry picking the year of which it was at the highest it's ever been, after we had put trillions and trillions of dollars into the United States economic system, and they're basing their argument on EPS not growing, and they're using it based on the comparison of the highest EPS year of all time. And they're saying, well, the markets are going up, but EPS has not been going up because 2021 was a unique year, and they're using a faulty argument in my estimation. So the reason the argument is faulty is because they're cherry picking the comparison to further their argument. And I'm sorry, that's just not a good argument to have.
Yeah, no, and I'm going to just punt on this one because this is not my area, but this is why I like having Matt around. When people do make these bearish arguments, I'm like, because like on the surface, Matt, I mean, this is how you can take data and make it misleading, right? On the surface, it's a good headline. Earnings haven't grown for the last 3 years. Why is the market high? Why are you thinking? But putting it in context and having someone that understands that context.
Earnings from 2010, again, Mark, I want to be very clear on this data because this type of analysis I find to be extremely lazy, honestly. When you look at 2010 to 2015, okay, from 2010 to 2015, earnings growth grew at net from 2010 to 2015, grew at net by 2%. And yet the market was up over 105% in that same time frame. I'm sorry, context matters when you're anchoring against where something was at a certain time frame in history. The context of that data point matters. And the context of 2008 data point matters because the market was coming through the worst market year we've ever had. And so obviously when the EPS contracted in 2008 and 2009, we were coming from a recovery type scenario. When you pull data and you're using the year over year numbers in comparison to 2021, 2021 was the highest year of all time. In fact, Mark, how about we do this from 2020? Instead of 2021, why don't we do the exact same thing from 2020? The exact same thing. So instead of 2021, where you're showing $52 a quarter, $52 a quarter, $56 a quarter, instead of those numbers, let's use the 2020 numbers and then make the argument, because the 2020 numbers are like $26 a quarter, $28 a quarter, and then 54 looks damn fine next to 26. So it really depends on when you cherry pick your data. And I kind of find that the bears who are making this argument right now are cherry picking the 21 data, because if you go to 2020, it's like, oh my goodness, this is the best EPS growth we've ever had of all time. In 21 to 24, you're like, oh my goodness, it's a stagflationary environment. I just feel like the cherry picking of data to make fundamental conviction arguments, I don't know who you're trying to convince, because it's not yourself.
You probably try to sell something, right?
Most likely. But so I don't know. I would rank this, honestly. I put a lot of emphasis on earnings growth. I put a lot of emphasis on EPS, and I personally rank this conversation right now as an 8. But how it is being utilized,
but this specific argument,
I would rank this as a -1.
So, I mean, okay. One of the things I learned about you in this segment is that most of the things, but the earnings context, when you take the totality of the earnings preview you gave and then the discussions, I would say you have some concern and some hesitation about what might,
I have
about
concern
the setting.
with the fundamental valuation and the froth at the top of the market. And my base case I'm working off right now is cyclical improvement and divergence improvement between RSP and SPY as we navigate earnings season.
And that will be confirmed through earnings numbers in those specific areas.
I will update that every single week in the newsletter.
Okay,
we'll obviously talk about it in the podcast as well.
That's cool, dude. Like, I've learned things. I mean, I still gotta I honestly am going to grab a couple beers, smoke some cigarettes, and think about any of the 3 scenarios that leads to a realignment of the market, and see if I can. I found that very thought-provoking.
And again, I'm not 1,000% there yet. But
I thought it was a good. I thought it was a good theoretical,
It's a great theoretical exercise to go through that. Scenario 1, scenario 2, scenario 3.
How does this end up? How does this end up? How does this end up? All right, listen.
That was a great discussion, Chuck. You really enjoyed it. Why don't you go ahead and set us out?
Yeah, listen, come be a pro member. The Master Trader event is free for all. 15th and 16th, the description of it will be in the YouTube channel if you're watching. or we'll put it in all over the place. Go to tackletrading.com. We're going to be highlighting it. This is a big deal for us. This is a big event for us. Come join on that. And don't forget to check out the holiday sale we're having. Listen, we appreciate you so much. You allow us to do what we do. We love this community, and hopefully you enjoy our insight. I think our insight is very unique, very different than you get in mainstream media. I think Matt gave a great example of that. I don't know how much I contributed to this podcast, but I did enjoy being on it because I thought this earnings discussion is a very important one. I think Matt painted a great picture. But have a great week, everyone. Yeah, just let us know if you need anything at all.
Definitely check out the Tackle Trading website for the store front for any of our holiday sales. Definitely come over to Tackle Trading, become the best part of Tackle Trading, and that is a pro member of our amazing community. And if you are looking for any degree of education, the best education you will find. And yeah, you might say, well, man, that's free. I just don't think you understand how tackle trading gets down from an educational perspective. We love talking about markets. We love talking about trading. We love trading. There is nothing more we love doing than educating our community on the best way to navigate the financial world. And so if you want to learn how to trade, you want to learn how to read trends and patterns and support and resistance, you want to learn how to wave count, you want to learn how to trade options, beginner level options, intermediate options, you want to learn how to cash flow, all of that is going to be in our upcoming Master Trader Live Workshop. 2 days, July 15th and 16th, 6 p.m. Eastern Standard Time. And all you got to do is hit that nice little register now button on the landing page in the description, and you can sign up for this amazing opportunity. And it truly is an amazing opportunity. And with that said, I hope everybody truly has a wonderful, wonderful rest of their week. And hopefully we'll see you in the halftime report this week.